Hi, this is Greg. Welcome to the channel. You know, a lot of subscribers have been asking me if I think the market is going to crash, and if so, when will the market crash? And of course the answer is I have no idea if and when the market's going to crash. I mean, we all know that it's massively overvalued, but it's been overvalued for some time. And you know the Wall Street adage, the market can stay overvalued for a lot longer than you can remain solvent. So this is something that is on a lot of people's minds. A lot of subscribers have asked me about this, so I thought I would address it in the video. But really the question is, what should you do as an investor if the market crashes? How can you be prepared? And what are some of the things you can do to protect yourself? And that's what we're going to be talking about in this video. So if that's of interest to you, stay tuned because it's coming your way. Now before we get started, please, if you get value out of this, please subscribe and like. It really helps with the channel. And also please, any comments below, I would appreciate to hear your comments because I love to answer them. Alright, now I've been saying on previous videos that the markets, meaning the stock market and the bond market, are at 100-year highs. Now that's a pretty astounding statistic, but it is true. And so the way I want to start this video is I'm going to show you, I'm going to go back to a valuation metric that I use. There's two of them. One is the Wilshire Price Index and the other one is the Buffett indicator. Okay, so let's take a look at those two charts right now. All right, this is the first chart. This blue line here is the Wilshire Total Market. This is a composite of the entire value of the stock market. It was developed a long time ago. You can see at 47.04, it's at the highest reading ever in the history of mankind. Here you can see the drop off due to the pandemic, and then when the Fed comes in with the money printing, the extremely accommodative policies, printing $120 billion a month of money and then buying securities, you can see how it has just rocketed up. If you go here, just for comparison purposes, this is the 08-09 financial crisis. You can see the drop off and then the continuing line on upward. Here, the green line is GDP. You can see the drop off with the pandemic and then the rise up. And this red line is very interesting. This is total assets at the Fed. You can see with the start of the pandemic, the Fed just started to gobble up fixed income securities, which is treasury bonds and mortgage-backed securities, and that has continued. Now the Fed holds an astounding $8.22 trillion, completely unprecedented and something that is just astounding. Now we go to the next chart. Now this is the Buffett indicator. Okay, and the Buffett indicator is defined as the total market capitalization of the stock market divided by GDP, gross domestic product, right? That's the output of the economy, all goods and services as an output of the economy, okay? That is the green line. You can see the highest reading in all of humanity, 207. I did earlier videos where I was saying that the market was insanely overvalued. I think the last one I did was at like 180 and change. Before that I did another one about a year ago where it was 147, where it looked ridiculously overvalued. Well, at that time it was the most overvalued it had ever been, but since then it's just extended to unbelievable heights of overvaluation. Okay, now this blue line, what they do here is they take the total assets of the Fed, which we saw on the other chart, and they add that to the denominator of the calculation here to sort of
normalize, or in a way subtract out the assets held by the Fed, and correct, so to speak, for that kind of distortion, so to speak. But here you can see it's still an astounding 150%, even by that measure, the highest it has ever been. And again, these drop-offs here are the drop-offs related to the Great Recession.
Okay, so it's clear to see by those measures and by other measures I could point to, the market is extremely overvalued. I think most investors and most professionals realize this and understand it, but they stay in the market, and I'm a perfect example of this. They stay in the market because they know that the Fed is still insanely accommodative. The Fed is still buying $120 billion of securities every single month. There is no such thing in the bond market as price discovery anymore. This thing is like Bernanke on steroids. The world has never seen anything this extreme, and I've expressed on other videos that I think the Fed is extremely behind the curve when it comes to inflation and when it comes to keeping the punch bowl out at the party for way too long. But let's take a look real briefly at what are the causes of this overvaluation. I've gone through this on many other videos, but let's review once again here. So the Fed has been way too accommodative for way too long. This is something that for debatable reasons, virtually every Fed chairman makes the same mistake. I don't know why. I guess it's something about being in that job, the feeling of power, the political pressure. They all seem to make the same mistakes. I go back to Greenspan, the .com era. He did it for too long. Bernanke did it for way too long after the financial crisis. And now we have Jerome Powell doing the exact same thing. By staying in too long, by being dovish for too long, by keeping interest rates too low for too long and being too accommodative, we create asset bubbles. And right now, I can tell you we have extreme asset bubbles in real estate, in the stock market, and in the bond market. And there are other asset classes that are also in a bubble. I would say that crypto, SPACs, all of these things are examples of excessive speculation. And I think that for some reason, these Fed chairmen, they get their head up their ass and they can't seem to see the forest through the trees. Number two, the investing public is far too bullish. Okay? Everyone you see on the internet, everyone you see in these chat groups, everyone you see on CNBC, everyone you see everywhere is bullish. Okay? This is a negative sign for the market. And if you look at the market, if you're a student of history, you see that at times where everyone's bearish, that is often the best time to buy. And when everyone is bullish, as it is now, that is a time to get very concerned and very worried. And the third reason is, I don't mean this to be insulting to anybody, but I believe it's true. I've been around for a while. I've seen a lot of market cycles and credit cycles, so I know that this is true. There are a lot of very inexperienced traders and investors in the market today which simply do not have enough experience or do not have enough time in the market to have seen enough market cycles to understand really what they're doing and when they should be cautious. Examples of this, of course, are, the Reddit investors, people in these chat groups and communities on the internet. These are retail investors that are just buying things based on pure speculation, that really do not understand how to evaluate the value of securities or the value of a company, or the future business prospects of a company. These Doge coins is an example of pure speculation. It's not to say that you can't make money. Sure, you can make money on pure speculation, but there is nothing underpinning the value of these types of assets. SPACs are another example. I did a whole video, which I'll put below in the description, about SPACs. In that particular case, it was EV SPACs, how I discussed certain EV SPACs that I thought were going to zero, and I expressed the opinion that SPACs for the most part are an outgrowth of this highly speculative market. Okay, so how do you protect yourself against these extremely high valuations? And in particular, if you've been in the market throughout this entire period, chances are you have some very nice profits, as do we in this channel. If you follow this channel, we've got some very nice profits in Exxon, Moderna's up like 400% since I recommended it, Intel, Boeing. I mean, a lot of these turnaround plays that I recommended at the height of the pandemic are showing very nice profits. And so how do you protect yourself in such a highly overvalued market and a highly speculative market in the case of a market crash? One way that I like to is to keep a healthy amount of cash reserves on hand. At this point in the cycle, in my opinion, you should be raising cash. You should be selling your losers. You want to hold on to your winners, okay? But if you have losers in the portfolio that just have not worked out for you, you should sell them and start to build up cash. Now, some people might call me too conservative, but I like to have, at points in the cycle such as these, 25% of my total asset value in cash. Why? A couple reasons. One is it reduces the volatility of your portfolio, but perhaps more important is if there is a significant sell-off and you've been following the market and you have certain favorites, things that you want to either increase your position or things you want to get into new that you know are good companies and have a great future, you'll have the cash to jump in and buy them at discounted values. The second thing is, don't use leverage. Okay, I learned this the hard way earlier in my investing career. In fact, when the stock market crash came in 08 and 09 due to the Great Recession, I not only was fully invested, I was using leverage. And as a result, I got margin calls when the market went down, and I had to sell things that I should have kept because eventually the market turned around. So if you have leverage or a lot of leverage, I would quickly start paring down that leverage and raising cash. Number 3, I mentioned this before, sell your losers. Okay, one of the biggest mistakes that people make in investing is they sell their winners and keep their losers because they don't want to take a loss. Okay, there's nothing wrong with taking a loss, and especially if you can take a relatively small loss, you should definitely sell your losers. Why? Because they're losers. And number 4, and probably the most important, don't fight the Fed. You want to watch very carefully what the Fed is doing. This is why we hang on every word of what Powell says, because we don't want to get caught when the Fed starts tightening monetary policy and the market basically craters. And I just want to say that the market is very vulnerable right now to a cratering. The first thing that's going to happen is he's going to start to lessen the amount of securities which he's purchasing every month. He'll probably go from 120 billion down to 100, which is still extremely excessive, but the market will view that as the beginning of a long period of tightening. There'll be a long period of tapering before you actually see any interest rates going up. So the fourth and maybe the most important reason is keep an eye on the Fed and try and stay ahead of what the Fed is doing. And I will do my best on this channel to try to make sure that we don't get caught. But if we do, that cash cushion and the lack of leverage will really pay dividends to you, and you will be happy you did, because not only will you limit your losses, but you'll also be able to take advantage of all the opportunities that come in when the market sells off. So if you got value out of this video, please subscribe and like. So the purpose of this channel is to make you a better investor and to help you make money in the markets. So be sure to subscribe so you can be on board for future videos, which will be coming your way very soon.